Yeah, so just looking at historical volatility as we come into the year, we've got some major pair, major stats for you. Refresh this every month for our tastyfx clients. And yeah, looking at that middle column is really what I want to highlight. We're looking at the expected move. This is the refreshed daily standard deviation based on the past 30 days. So based on the past 30 days, we've had a couple non-trading days, a couple holidays.
Right.
So perhaps coming in a little bit. But yeah, where I really want to highlight is this this yen has really come in.
Right.
We've seen that for months prior be well over 100 pips.
Yep.
Now coming into 77. This
Euro a bit fatter.
Yep.
Yep.
40 pips expected, plus or minus in a day. And this pound, I think, has been pretty consistently higher than the euro in recent months.
Which is not traditional, usually.
Right.
You usually, honestly, you kind of trade that traditionally like a 2-to-1 ratio. So as a pairs trade. Obviously, when you trade euro sterling, you've got the pairs trade right there. You can trade it any size you want. One of the great things of SpotFX is, again, I go back from my futures where I started my career, and to build a currency non-dollar cross, you had to actually buy one futures contract, sell another, and make sure you got the weightings right. And inevitably, you were always left with tail. It's a more challenging way to construct non-dollar based pairs. What do you see from the carry? Because that's something a lot of traders tend to look at.
Exactly.
We are seeing U.S. rates lower, but the pace of which they're falling is now the question. We're down to, I think, one rate cut in 2025.
Yeah.
That was off from a high of 7
But
middle of last year.
Yeah, traders often look for this positive carry, but here looking at these major pairs, we're only seeing 2. This is all indicative. This was pulled yesterday, and so we're only seeing 2 pairs, against the yen and against the Swiss franc, where you do get some of that positive carry. And historically, this dollar yen has paid you a lot more, theoretically, to be long yen, and right now, under only at 0.77 pips. So
what does that tell you? Is a new trader or someone new, new to FX markets? When you look at the carry trade, we know that dollar yen has gone from 100 to 164 because of that interest rate differential on that carry, that getting paid carrying that position.
Yeah.
Every day we saw a big unwind of that in late October or excuse me, in August. The fact that the carrying charges are basically kind of wrapped around a push right now.
Yeah, I think that it's important to know, and I think it's especially prevalent now, that you're comparing these daily standard deviations with this carry, and you can see very easily that even though you're picking up a positive carry, that position could well be erased by movements in the underlying, and so it's getting pretty tough to pick a spot if you're thinking just positive carry without being very long-sided or long-term expectations in favor of your directional that you're picking.
Okay.
So I think
that's absolutely a great observation in terms of, traders work for a number of different reasons. Institutions trade FX because they have to hedge actual or manufacturers because they have goods they have to sell in foreign countries. You have speculators trading, asset managers looking for diversification, people looking for a return within the carry trade. As that changes, their appetite for participation changes a little bit too. So if you can say one of the drivers over the past 2 years has been this fact that Japanese rates have been 0 and U.S. rates have been relatively steep, but at one point close to 5%. We're certainly not seeing those be a push, but we are seeing the carry get a little bit tighter, which is maybe doesn't change your bias, but it actually speaks to a little bit of a change in opportunity. Right. So not something that again, it doesn't say that I don't want to be long dollar yen now, but it does put on the table one of the reasons that that vast group of participants trades is becoming a little less interesting for that particular group.
Exactly.
So it's very good. Now, client sentiment is, again, this is something specific to tastyfx. This is how tastyfx and IGFX customers globally are positioning themselves either long or short. Now, this is one slice of a very large $7 trillion a day FX pie in the global FX markets. So, again, you take it with a certain amount of context. People like to look at it both ways. Momentum guys like to, well, if the herd's long, I'm long. Other people are the contrarian. Well, if they're all long, they're usually wrong. I want to be short. Feel free to use whichever way you want. It's an interesting indication. Sometimes it's a little bit indicative of, and this is what we'd expect to see. Aussie US, we know we were at multi-year lows.
Right.
We're slightly off that right now, but the preponderance of traders right now are long Aussie. So they're looking for a correction or a reversion. The same way dollar Canada, well up to those multi-decade highs, majority of traders short there, looking for a little bit of reversion. Does that make anybody right or wrong? No. It's just an indication of a small subsets of positioning, but an interesting insight. Anything we can get that gives us a little bit of insight into it is good. So let's take a walk through.
Yeah, last thing to highlight on this sentiment is, as you'd expect, a lot of people are short dollar now, just expecting that reversion that hasn't come for many, many months. But you're seeing against the Swiss franc, you're still seeing long dollar.
Yeah.
So that's the one outlier there. But yeah, if we're taking a look, as we're talking about volatility, I thought it'd be interesting to visualize it where we're at today. Pick 3 months to look back to get a more granular look since the election. And as you can see in the far right, at the beginning of November, seeing that big spike post-election. But now where we stand off of where we were after those election highs, but now we're seeing the most volatility in the Kiwi dollar.
Interesting.
Yeah, and we'll take a look later at what historically is the most volatile, but the least volatile right now is that dollar CAD.
Right.
And we can say kind of expect it with the proximity between us and Canada. Those often move in tandem, but it will be an interesting one to see if maybe there's any political shakeup right now, because we are at all-time lows for the Canadian dollar.
Yeah.
And I don't know as much about who's going to take over. I think they just elect from their party.
I think so.
And so it shouldn't be too crazy, but if it comes to a general election, I think they're now saying that conservatives could swing the majority, and maybe the currency is a big platform piece there. And we do see an uptick in volatility.
Let's take a look at that. So this is the 3-month volatility, which is not when I say not normal, it's not traditional. Kiwi sitting up there, Aussie sitting so low, Euro sitting below yen. Let's take a look at it historical, because this is really interesting.
Yep, and now we're seeing who is the majority of the year at the top of the table here. We're seeing that pink, that is dollar yen.
Right.
And so a big story in 2024, a lot of volatility there, but a lot of ebbs and flows. So right now coming down from November highs and from December, that spike in vol across markets early in the month. So it'll be interesting to see where we're positioned, a little muted. Yeah. Interesting to see maybe with inauguration, we see an uptick, maybe with non-farm payrolls this week, anything to reset. We've seen the most kind of readjustments, vol spikes in kind of those recentering expectations for what the rate path will be, and stuff like elections and political and economic policies. So not sure what January will bring, but yeah, we're positioned a little muted. And we'll see what'll spike it this time.
All right, great stuff, Glenn. Fantastic walkthrough. We'll see you back here tomorrow. Have a great day.
Thanks, guys.